Generally speaking, my stock pick is just a stock that I happen to think is a great pick that week. I analyze all the fundamentals about the company, trying to look for companies that have either a durable competitive advantage, fantastic returns on investments, or another way meet Warren Buffett's precepts for what makes a great company. I analyze these companies in a vacuum without looking at the stock price. I simply look for fundamentally solid companies. Once I've done that, then and only then do I look at the stock price to see if I'm getting good price for the value of the stock that we're looking at. Hi, I'm James Robinson, and this is my stock pick of the week. This week's stock is Waddell & Reed, symbol WDR. Waddell & Reed is an investment advisory company. They have assets under management of $65.8 million. The company was founded in 1937. WDR employs 1,332 full-time staff. They're based out of Overland Park, Kansas. As of April 16, 2019, the market cap of the company was $1.42 billion. It had revenues of $1.1 billion, profits of $183 million. The company had a PE ratio of 8.23%, which is the reason I'm interested in it. The PE ratio is so high. Also, the yield, the dividend yield, is 5.76%. Again, I like high dividend yields. And finally, the debt is only $94 million. So the debt is about 6 months worth of income. So here you see my standard heat map ranking of the company. Again, I rank the company in 29 categories, 9 of which are operating costs or operating issues, 10 of which are financial, and 10 of which are management. Management measures how well the company does at returning money back to the shareholders. Financial looks at how the company handles risk, and operating looks at how good a job the company does of providing goods and services to their customers. So you can see this stock has a total GPA. By the way, 4 is the highest you can get, 1 is the worst you can get. This company has only 2 or 3 categories where it's average. It's above average in every other category, including its management, which is very high at 3.6. So the total GPA is 3.38. It's amongst the highest of the companies that I've looked at. So just looked at from this simple method, this is a fantastic company. So if you look at this, the next slide is always gross margins. I like gross margins. We talk about it every week. Gross margins afford my companies the ability to make mistakes and still be profitable. 1999, this company had fantastic gross margins. Those gross margins eroded down to about 2010, and they've been very constant since then. They're in a good level, and the company has no debt and pays a good yield, so I'm interested, even though I'd like this number to be a little bit higher. But they've been very, very stable, very, very consistent, which I like a lot. That means that they do have some ability to have pricing power. It doesn't seem like they're getting a lot of pressure from the outside world in terms of their business model. So the gross margins are stable, not spectacular, but they're also not worrisome, and I like the yield, and so I don't mind holding it, knowing that my yield is relatively stable. So earnings and earnings per share, first of all, there's not much difference in terms of earnings and earnings per share. The company has bought stock in the last 10 years, but not dramatically so, not enough that these two charts would be very dissimilar. So we'll just talk about earnings in terms of total dollars. If you look, the company has gone from about $50 million in earnings in 2006 to about $200 million worth of earnings in 2018, which is, quadrupling over 15 years. That's fantastic. That should be cause for joy. The problem is the company had great years in, 2013 and 14, and then they've had 3 years of declining profits. So you see this sort of up and down. If you look at it in the long term, these earnings are pretty stable. But if you just look at it in the last 3 years, I think they cause people concern, which is why I think the PE ratio is so low. I think that you just kind of ignore 2013, 14, and 15 and say the company's gone from 50 million to 200 million in 10 or 12 years. It's pretty good returns. Net earnings as a share of revenue, what I'm really looking for here is consistency. I like to know the company's going to be in a pretty narrow band, and this company really has. It's, really always in between sort of my goal and the top 25% of companies. So this company does a very solid job in terms of taking revenues and delivering to the bottom line, and they're doing it pretty consistently. So this is just, again, what I'm looking for here in a company that's got such a low PE is red flags that would lead me to believe the company's in trouble. And I'm just not seeing it here. I think this company continues to be stable. Every week we talk about my 4 taxes. They are selling and general administrative costs, plants and equipment, inventory, and R&D. Those are costs once you've supplied your customers with what they need in terms of cost of goods sold. You have these costs to run your business, and some companies take their eye off the ball and do a poor job. Other companies do a good job. I try and keep track of that. Selling and general administrative, this company is in the top 25%. That's great. Again, it's been very, very flat since 2010. That's great. The company is better than average, but not fantastically so in terms of plants and equipment. They happen to own an awful lot of office space in Overland Park, Kansas. And I think that's one of the things that pulls them down a little bit, that they do have a lot of money tied up in their office space. The next one, inventory and R&D. They have no inventory. That's great. You can't get hurt if you have no inventory. And R&D, it was very flat. In fact, it was zero until 2015, and then it started to increase. For them, R&D is having experts that they've hired to research companies for their investment advisory research. So I think that's just a cost of doing business. It's been flat for the last 3 years. I'm going to assume it's going to continue. The company did manage to turn a profit, even though this number has gone up. The profits have increased in the last 12 months. And so I think this is kind of a non-issue. All told, my four taxes, there's nothing really here that scares me about this company. Debt analysis, total debt, which is total current liabilities and total long-term debt, from 2014 has dropped from about 350 million, from about 600 million to about 400 million, so it's a nice drop. Most of that has come in total reduction of total current liabilities, although there has been a drop in long-term debt as well. So again, the company's paying off a little bit of debt from about 175 million to about 95 million. So they paid off about $100 million worth of debt in the last 3 years. They've also reduced current liabilities. That shows they're doing a good job of running the business more and more effectively. So these are, again, reasons for me to believe that the PE ratio is too low for the company and the dividend yield is great for the company, which gives me two ways to make money. I make money in dividends, and I make money as the market recognizes this company is solid, and I get a higher and higher PE yields. So years income to pay off long-term debt, I like to see it less than 3.5 years or 4 years. These guys are about 6 months, so this is fantastic. This is an A+. Not much to talk about here. Interest expense for this company is relatively small. It's like $6 million. So when a company makes $180 million to pay $6 million in interest, again, that's an irrelevant number. We're not going to waste much time on it. Same thing with interest expense as a percentage of operating income. It's nothing. It's a rounding error. So again, we're seeing this company just solid in category after category after category. Cash and marketable securities. It's gone up effectively almost every year since 1999. By the way, it's gone up. It went up in the last couple of years, even though they paid off $100 million worth of debt. So lots of cash on hand, more than enough cash to run the business. Very conservatively run. I'm very happy with it. Current assets to current liabilities. They've got almost over $1 billion in current assets. Current assets and current liabilities are costs. Current liabilities are costs they're going to have to incur in the next 12 months. Current assets are money they either have or they expect to get in the next 12 months. So you can see that they have about $350 million of costs they have to pay out in the next 12 months and over $1 billion of current assets. So more than enough money in the bank to run their business intelligently without any panic. Shares repurchased. This company has repurchased shares. They've done a reasonably good job at it, but they haven't purchased a lot of them. They bought back about 5.2 million shares since 2008. So it's nice. They bought back about 10% of the company, 7% of the company. But it is some effort to return money to the shareholders. I think that trend might continue and might accelerate. If you look at it since 2013, they've really sort of ramped it up a little bit. So hopefully that trend can continue and further enrich us. So to put this in perspective, if you owned 10% of Waddell & Reed at the end of 2008, you would have owned about 8.5 million shares of stock. Today, through repurchases, your 8.5 million shares of stock would have increased your ownership from 10% to 10.9%, so really would have gone up about 1%. Not very much. It's a 10% increase in your holdings, so you get effectively a free 10% boost for doing nothing. Your share of the company's earnings, well, the company made about $100 million in 2008, and it made about $20 million in last year, $200 million in last year. So your share of those earnings have gone from about $10.5 million to about $20 million. So the stock repurchases have enriched the shareholders just as you'd expect. Dividends per share. This is a mixed bag. If you were to ignore what happened between 2011 and 2016, and just look at that stock, at that chart, you'd say, wow, the dividends did great. They went up a little bit every year. Some things happen, and I don't even know what they are, and I really don't care too much what they were. But in 2012 and 13 and 14 and 15 and 16, they kind of got ahead of themselves in terms of dividends they were paying out. If they had kind of kept to that simple pattern, the company would have been a lot better off. One of the things that's hurt this company's stock price, one of the things that's hurt its PE ratio, is that they've cut their dividends twice in the last 5 or 6 years. That's not something shareholders want to see. Having said that, again, if you ignore those few years and just kind of looked at it in more the aggregate, more the long-term view, it's been relatively consistent. I don't understand why they paid those big dividends. In theory, if you'd been a long-term holder, you'd have benefited from those. But I look at it now, and we're going to talk about it in the next few slides. The dividend is extremely safe, is extremely conservative. There's no reason the company can't continue to pay it. And so I don't see further cuts to the dividends as being a future problem. So, especially when I buy a stock, specifically because I really like the dividend, I like to look at the company's dividend from several different angles. So I look at it in terms of yield and growth. So what is the yield and how much is that yield growing? Dividend safety in the context of earnings. So what percentage of our earnings are we paying in dividends, and is that sustainable? Dividend safety in the context of cash flow. So again, what percentage of our cash flow is being paid on dividends, and how sustainable is that? And finally, dividend safety in the context of its current debt load. So we'll go through each of those with a slide. As we touched on earlier, the dividend kind of got cattywampus for several years. It currently pays a 5.74% yield, which is fantastic, about 3 times the yield of the average S&P 500 company. The average dividend growth has dropped 3% in the last 5 years, which is the measure that I use here. But again, I think if you looked at it from 1999, you'd see that the average growth is that the company has grown dividends consistently over that period of time. So I'm ignoring kind of the bad news for the last 2 or 3 years. I'm looking at the bad news the last 2 or 3 years as the reason I'm able to get this price for the company and sort of the price that I pay. I know I'm going to have to grow dividends for a couple of years to get those PE ratios back where I want them, but I think we're going to see a 12 or 15 times PE ratio, which is going to double the value of the stock. And while I wait, I'm making just about 6% on my money in terms of dividend yield. So dividend safety in the context of earnings. The payout ratio for this company is 44.3%. So you take the profits, 44% of those profits get paid back to us as dividends. That's really pretty average for the S&P 500, which the average is about 40%. The average payout for the last 5 years is 36.8%. Now, a lot of that is because 2014 and 15, they did tremendously well. And then 2016 and 17, they didn't do as well. And the payout ratios were pretty high. And now the payout ratios have been pretty sustainable. But I think you can see that by looking at the chart. So dividend safety in the context of cash flow. So the dividend safety of free cash flow is 22.9%, extremely conservative. The average dividends payout ratio for the last 5 years is 37%, less conservative, but still very conservative. Again, these numbers speak for themselves. I think that we've got no problems with the new lower dividend rate. That number, I think there's no problem with that problem. I think there's no problem with that number being sustained and increasing over time. Dividend safety in the context of the debt load. What I do here is I look at interest rates. As interest rates increase, does it create a problem for the company's ability to continue to pay dividends? So the company's average debt load now is just over 6%. Interest rate is just over 6%, which by the way is a little higher than I'd like to see, but not, again, we're talking about such a small amount of debt relative to the size of the company, it's not worth losing any sleep over. So if interest rates went to 20%, this company would be paying about $12 million more in interest than they're currently paying. The company has, after cash flow, the company would still have $341 million of cash flow. It currently pays $81 million worth of dividends. So the free cash flow minus dividends would still be $260 million, which means the company would still be at about a 33% payout ratio. So if interest rates went to 20%, what this is really telling you, if interest rates went all the way up to 20%, it would have almost no effect on this company's ability to pay its dividends because its debt load is so low. Shareholders' equity, you see this continues to increase year after year after year. Since 2019, it's effectively quadrupled. Again, solid stats for this company. So return on assets, the red line is the top 10% of companies out there. And this company is, always at or above the red line. It's a fantastic company in terms of the way it efficiently uses assets to pay its shareholders money, to turn profits. This is one of the key things that drew me to the company in the first place. So the first question I like to ask about a company is, does it have a consumer monopoly? And in this case, the answer is no, I don't think that it does. I'm not buying this company because I think it has a consumer monopoly. I think this company is a solid, stable company in an older industry which will continue to chunk along and do what it's been doing. I don't think it has a consumer monopoly so much as people do business with it out of habit. But I think the company is very solid financially. It has $94 million of debt and $180 million worth of earnings. So I can't imagine that either A, they're going to stop making money, or B, the debt is going to dwarf this company and take my investment to zero. Does the company reward its owners? Yeah, the company pays an above market dividend, even though that dividend was adjusted down. It's now in a very sustainable range. In 2008, since 2008, the company's repurchased 5.2 million shares with a market value of $97 million. The company's total market value is about $1.4 billion, so they bought back about 7% of the company's value. Looked at in terms of the very long term, the company's done a great job of increasing earnings year after year after year. There have certainly been bumps, but the good news is those bumps were income going up dramatically, preceded by it sort of trending back down to normal, versus a bump which is worse, where the company all of a sudden starts losing money and then trends back up to normal. The company has excellent return on assets and equity, combined with the dividend and the high PE. That's what interested me in the company in the first place. So to buy this stock at its current price of $18.77, yes, I absolutely would buy this stock. It's a great company. So let's go through the stocks that we've suggested you should buy and talk about how they're performing. We told you to buy Altria on February 4th. It was the first stock we suggested. We sold it for a 19% profit 56 days later. That's not something we're going to do all the time. That was just a lucky break, which we took advantage of. We sold that stake in Altria, and we reinvested we left our profits in, but we took our investment off the table on a slight profit. So we're now in the black forever on Altria. We can never lose money. Pays a nice 6% dividend on the money that we reinvested. On to the next problem. T. Rowe Price, we told you to buy on the 15th of February. We've owned that stock for 60 days. It's currently up 8.3%. Very nice return on investment. AGX, which is Argon, we told you to buy on February 22nd. We've owned that for 53 days. It's up 9.2%. Martin Transportation, we told you to buy it on March 8th. It's up, so it's 39 days ago. It's up just over 1%, not much to write home about. Apple Computer, we told you to buy on March 22nd. You own it for 25 days, it's up 4%. Our Altria stock, which we left our profits in the company, we sold that stake on the 1st. It's down a little bit since we kept it, but again, we don't care, that's all profits. H&R Block, we told you to buy on April 8th. That stock's up 5.3%. And then Waddell and Reed, we told you to buy it we bought today at 8.77. It shows it got a slight loss. That's just because it's gone up a little bit today since we bought, or since the opening price is what's recorded here. So long story short, we haven't made any money. We've owned it for less than a day. So long story short, in 65 days, we've got profits of about $4,300. We made a couple $100 in dividends. So that's our stock report of the week. Thank you so much for your time.